For years, people have talked about issuing tokens, stablecoins, and other digital assets on alternative chains. Ooh, altcoins, all that sort of fugazi. But nowadays, thanks to some incredible protocol advances by notably Lightning Labs, we are now able to do this on Bitcoin itself. So, to unpack the technology and its implications, we have three of the best possible people you could hear from today. The first up is Olaoluwa Osuntokun, who is the CEO and CTO. He's just the CTO. Sorry, I almost promoted you there. And the co-founder of Lightning Labs, the company building some of the most powerful infrastructure for Bitcoin and for Bitcoin Lightning. We have Adam Back, the CEO of Blockstream, the legendary cypherpunk, and the shopping bag model. And I know you can wait, I'll introduce you one by one. And we have Federico Tenga, who is the... Hold your horses, guys. I know you're excited. Federico from Bitfinex R&D, who's been hands-on developing and testing ways to issue assets directly on Bitcoin. To guide this discussion, we have one of the clearest and the longest-standing voices in the Bitcoin space. It's the podcaster, it's the educator, it's the Bitcoin extraordinaire. It is Stephan Livera. So please, welcome my panel to the stage. Give them a really warm round of applause. Panel, the floor is yours.
Okay, well, first of all, thank you, Joe, for a great introduction. And yeah, we're going to be chatting about Bitcoin assets. Now, I'm going to just, I guess, let's start with the why question, right? And obviously, most of us here, we're all bullish on Bitcoin. Many of us are Bitcoin maxis. Obvious question most people are going to have is like, why do we even care about other assets? Why do we even care about other assets on Bitcoin? Or let me spice it up a little bit. If I were to say, okay, sorry, I think the microphone's a little. Yeah, okay. So if I were to spice it up a little bit, maybe Bitcoin is what we can actually own and control self-custodially, and other assets are okay to be on some kind of custodial TradFi style platform. So let's go down the line. Let's hear your answers on that. Like, why do you care about assets on Bitcoin using this kind of, some kind of cryptographic protocol as opposed to just, trust me, bro, some kind of, centralized platform?
Yeah, good questions. I would say I care about it because I care about sort of like the Lightning Network itself, right? And our goal is to sort of like, make this into like the decentralized payment network of the entire world itself, right? And so to me, it's sort of like a stepping stone, right? Where today people can do Satoshis and Bitcoin on Lightning, and it's great. But if we can actually like allow people to actually have stable coins on their own wallet, basically, it's now a more gradual way to basically first start hosting stable coins and actually go on to the Bitcoin network itself, right? So we can actually bridge and utilize this existing liquidity of the Lightning Network itself for these additional payments on the edges. And maybe this is useful for like consumers that maybe aren't necessarily ready to basically go 100% in on Bitcoin itself, but they can have stables, right? And they can use that to go. So.
You can watch him on half speed later. So it's a common question, what Stephan said, which is, if you have a degree of trust required in the asset because it's a stablecoin, and the stablecoin company has the treasuries or the backing assets, you are trusting them to not spend those assets or, for their auditor to correctly audit them and so on. And the same for a company, right? If it's shares in a company or anything like that. But I think ultimately the point is other than that risk, it's convenient to have assets in the same kind of blockchain platform because then you can use Bitcoin-like smart contracting on top of it. So you can do an atomic swap. So for example, that's why it's interesting on Liquid or RGB or Taproot assets to have Tether, because then you can do an atomic trade or atomic swap between Tether and Bitcoin, which will give you generally a lower risk way to trade Bitcoins for dollars or other assets, if those are hash rate contracts or company shares and things like that.
Yeah, I mean, not much to add, but yeah, there are basically two angles to it. One is the fact that Bitcoin offer better security guarantees. So sometimes the trust me, bro platform, sometimes it's good enough, sometimes it's not. So definitely there is some market participant that appreciate the better guarantees that Bitcoin has to offer. Also just the fact that it's a neutral playground, it's not someone else's playground, which is something that, yeah, sometimes is okay, but sometimes people may feel uncomfortable with. And then the other angle is at the end, yeah, with the biggest asset in this, if you want to call it the crypto industry, in the end is the Bitcoin. Is the 10 times more liquid than any stable coins, 10 times bigger. So right now, if you want to play some DeFi games for stablecoin against Bitcoin, you end up going in other layer ones and having to use wrap Bitcoin, which yeah, maybe can be good enough for some people, but it's not ideal that you need to trust this bridging trusted mechanism. While once you have stablecoin or other assets on top of Bitcoin, that anyway they already have some layer of centralization. So so it makes more sense that they come to Bitcoin rather than Bitcoin going to other centralized layers. So you can have native swaps or native interaction between real Bitcoin, not wrapped, not bridged, and USDT, other stablecoins, other assets.
Okay, so just maybe for people who aren't as familiar with what you guys are representing, I guess Taproot Assets, Liquid, and RGB, can you just, each of you take a minute or two, just give like a very high-level summary just for people who aren't familiar with like how the ecosystem works, and from an asset perspective, what are the features there? Just kind of quick overview, each of you, please.
Yeah, so I work on Taproot Assets basically, which is like an issuance protocol on Bitcoin. So you can use it to sort of like issue an asset and then send them and do all that stuff, right? It sort of distinguishes from maybe like prior generations where other protocols maybe they embed data directly into the chain itself, and that's sort of like seen as something that maybe is undesirable because they're actually filling off the block space with things that maybe aren't necessarily just directly about Bitcoin itself, right? So what this protocol does, similar to things like RGB, client-side validation, instead of like putting the actual data into the chain, you put just a hash of the data into the chain itself, right? This means that the transaction looks like any other transaction basically. It can't be distinguished. Also, it uses Taproot, meaning you just have like a single public key and it looks like any other transaction there, right? So that's like an important part of capability. Another thing that we do, we always make sure that it's actually like client friendly, right? Some of these other protocols, you require sort of like an indexer, something that maybe has like 500 gigabytes of data on top of the actual Bitcoin chain itself in order to actually understand and know where all the assets are, right? But obviously the most important thing is to be able to run the numbers, right? So with Taproot Assets, you can basically just have a light client, so like an SPV node on your phone basically, and it's able to actually accept a proof and verify that it actually exists and things are being done properly, right? So that's like a big thing. And generally, we always try to make things as Bitcoin friendly as possible. So rather than like inventing like a new VM or new programming language or whatever else, it's actually just Bitcoin all the way down. Like anytime you're generating a signature, it's actually a signature of a Bitcoin transaction using the wallet utilities and libraries the internet else knows. And one thing we worked hard on is also making sure we have like native Lightning Network support as well too, right? So you can basically have like a normal Lightning Network invoice basically, and you can pay it, right? Maybe I receive USDT on the other end. Maybe you paid with USDT on the other end, right? So I can actually send an asset and you receive something else, and that's very important in terms of like actually having an ability, because the main thing is to actually reuse the liquidity in the Lightning Network itself rather than starting from scratch for every single asset created in the network itself, right? So you don't actually need to make an entirely new Lightning Network for USDT or whatever else. You can actually just use the existing network today and plug directly into it, which is actually very useful in terms of like bootstrapping effects and making sure that people can reuse all the wallets that they can use today, right? So any wallet that's unupgraded can actually send one of these invoices. The person receives USDT and the other way around. And I think that's one of the big things that we've been working on over the past few months.
Yeah, I mean, RGB is yeah, with RGB we actually is quite similar in the scope, which is like enabling people to issue and transfer assets directly on Bitcoin. So the way it is achieved is by assigning assets to Bitcoin UTXOs, and then you can move the asset by proving that you're the owner of the UTXO, which is by spending the UTXO. So we basically achieve ability to move assets on Bitcoin without any trust trade-off, without introducing validators, orchestrator, federation, or any kind of that stuff. So this means that also then it is naturally compatible with layer 2 solutions like Lightning Network or possibly in the future other stuff that helps Bitcoin to scale. And there is the added benefit of good privacy, because since it's like the RGB transfer information is not put on chain, which is first of all good for not blotting on the blockchain with information that is not relevant for Bitcoin node operators, and also you have better privacy because on-chain blockchain observer doesn't see that that Bitcoin transaction involves also RGB assets, which is something that people start caring about more and more these days. Oh, okay.
Yeah. So I mean, to summarize, I think the difference between RGB Taproot assets and Liquid, effectively RGB and Taproot assets I think of as a kind of more modern color coin protocol, and people may remember the color coin idea that you would sort of watermark a low value Bitcoin transaction as a Tether coin or something else, and then with Liquid, because it's a side chain, you can do the issuance and the transfer off of the main chain. So There is a connection to the main chain, which is the fee asset or native asset on a liquid chain is also Bitcoin. It's using a peg mechanism, somewhat like vaguely like the way that you move Bitcoin between a Lightning chain and the main chain, but using a federated model. In the future, maybe that federated model can be increased slowly towards trustlessness. You see the big discussions about BitVM. That is a way to move from a threshold signature security model to a one of n, so one honest party can protect a peg. So it's kind of interesting innovation for that. I think the other difference between Lightning and a sidechain is a sidechain can introduce new contracting things where I think, with Lightning, each Lightning transaction is a valid Bitcoin transaction, so it generally doesn't. Now, it's interesting with the client-side validation model that it can actually introduce confidentiality for the asset, so it brings some of the liquid technology into the client-side validation model, which is a kind of interesting innovation. So I think ultimately, in terms of main chain footprint, liquid is lower because the assets are issued natively on the sidechain, so the main chain doesn't see them. If there are Bitcoins involved in a transaction, like a Bitcoin trade for a stablecoin, the Bitcoin made its way onto liquid via the peg, and so there is, some main chain fees related to that. But I think, it's a question of how much footprint on the main chain, and so liquid has less of it, and maybe more flexibility to do kind of more innovative smart contracting things because it's able to have different capabilities in a chain because it's a chain, whereas Lightning is, not a chain. It's a kind of write back cash on top of Bitcoin. But I do think the client-side validation is a kind of hybrid because it can introduce new features, which is quite interesting.
Now, my next topic in question is the type of asset. So there's stablecoins, there's tokenized equity, tokenized debt, or maybe Peter Schiff likes tokenized gold or whatever, right? What do you guys see as the main use? I guess, is it maybe an outsider might look at this and be like, is this mostly a stablecoin thing or something else? How would you guys comment on that?
Yeah, I would say that right now stablecoin is the only one that proved to have a very good product market fit. So everything else still needs to demonstrate that there is substantial demand. I mean, demand comparable to the stablecoin one. So we'll say at the beginning it's going to be mostly stablecoin, then which enables the DEX use case to trade stablecoin against Bitcoin. Then of course, now there is also seems there start to be some momentum also for tokenized asset, tokenized securities, tokenized commodity or other stuff. And I think it would be very good to have also them on chain, on the same network with Bitcoin and stablecoin, because then it enables to have, again, decentralized trading between them and to have like all of them in the same wallet without having to deal with the different layer ones. So there are certainly advantages from the user point of view for that, because the advantage of tokenized securities that you can move them very easily between brokers, between service providers, between venues where you can trade them. That is not the case right now. So for sure there is utility in that. There will be a market for that, but I think it's still too early to say whether or not it will be anything comparable to what we're seeing with stablecoin nowadays.
Yeah, I mean, I think you see different assets being issued. So on Liquid, there is about a bit over $4 billion worth of different assets. There's a bit of Tether, there's a bit of Liquid Bitcoin, but the bulk of it is other assets, corporate bonds, Bitcoin mining hash rate, securities, promissory notes, so small business loans, over $2 billion worth of small business loans. So you can see that there are organic use cases which are kind of moving to this open settlement network for people to have an electronic, I mean, it's kind of like the traditional finance, all the assets are settled in a back office, which basically means, an offline or VPN protected database of a bank that you have to trust. Whereas with the blockchain, you have an open settlement network. With Liquid, you have confidentiality, so you can kind of have the open settlement guarantees without losing the confidentiality of what you're trading for what price. And so I think that is a beneficial technology for moving the financial rails to a more modern system, because the old systems are quite slow. It's sort of T+2, T+1 settlement errors, committees of humans to resolve the settlement errors. So the blockchain itself, which Bitcoin introduced, now has wider uses, which is to provide atomic settlement of trade on a real-time cash basis, or nearly real-time, in a way that doesn't end up with human conflict resolution, and to do it on an open fabric. So blockstream, we've been saying that the future of finance runs on Bitcoin, which is to say that the Bitcoin network is by far the most secure and robust blockchain technology. All of the altcoins have generally ended up with more fragile systems, and of course you can't do that all on the base chain because it overloads it. So I think that's where more efficient ways to use the base chain, like RGB and taproot assets, and different types of layer 2 that are able to actually issue the assets in a layer 2, like Liquid, and there are some other sidechain-like concepts. So I think that's that's an interesting use case, and it is delivering kind of value for a longer tail of financial assets that are, of course, there are public companies that have been securitized and tokenized and provide 24/7 trading in Liquid, but I think it also opens the opportunity for kind of more types of securities that are, too expensive to go through an IPO process or something like that.
Yeah, I mean, so taproot assets is like a decentralized protocol, right? And therefore, like the developers can't necessarily restrict exactly what people do on it. The other thing as well is that data isn't actually put directly on chain. Only the hash of the data is put on chain itself, right? Meaning that like what we see is asset created, where people actually selectively revealed to other individuals. I think that's a great thing about client-side validation protocols, is that like I only need to keep track of like what I care about and like what I actually want to validate and like what I think is actually valuable. And so there maybe will be like a long tail of like random stuff that people are creating, like Pokemon card type of thing, whatever else, and we don't necessarily need to care about that because it is fully permissionless, right? But I think like Federico was saying, I think the main one that like is relevant is sort of like enabling more people to use Bitcoin as payments, basically. I view this basically as a stepping stone into that. So many of what we've been doing is making sure that people are able to use this effectively on Lightning and with stablecoins as well too. But otherwise, like because permissionless, people can do whatever they want with it. But I think there will be sort of just a few killer use cases basically that people actually find value in versus just maybe doing rampant speculation on the side. So
let's think a little bit about users, and let's make it, I guess, pragmatic or easy for people to think about. As I'm kind of imagining, you could have different kinds of users. There might be like a degen trader, DeFi person. There might be high net worth. There may be institutions. There may be kind of unbanked or underbanked people who want access to Tether, USDT, or some stablecoin. Can you guys elaborate a bit on who you see being the end user of these protocols, of these assets on Bitcoin?
Yeah, I guess I can go. So one end user, like, I have in mind, like, so I actually came here from Nigeria. Like, I took like a flight to Frankfurt and then came over. And, one thing, I had some friends that were, with us, at the time as well, and they found it like sort of difficult to like pay for things day to day. Because typically, like, people, even though they have cash, like they use this sort of like bank transfer system. It's actually sort of like an instant bank transfer system, which is actually, relatively effective. But then there are a lot of individuals that like want to be holding sort of like either Bitcoin or even the dollar itself, and then still be able to pay for things directly themselves. So you can imagine someone has like an application, it's like a mobile wallet basically, where you're actually able to hold stable, but then actually do sort of like a swap type mechanism to basically to pay in Naira, right? So I think those are actually big users. People in all these other countries that maybe have had a lot of inflation in their own currency, or maybe they don't necessarily trust the central bank, or maybe they don't necessarily even really have access to those type of facilities, basically. I think that's definitely like a key user, and one that we've seen around the world, and we see in a lot of volume, we see in all these other countries, basically. And like Federico was saying a little bit earlier, I think that's what has product market fit today, basically, and what we're going after. And I think there can be a lot of value added there too, because this also gives them a way to also cross back into Bitcoin more easily, right? Maybe before they would have had to had some sort of like exchange or some other financial services there, but now they can basically have Bitcoin, have a stable, maybe have the local currency basically, and then move back and forth. So now you're actually able to provide them different financial services as well that maybe weren't necessarily accessible in the past.
Yeah, I mean, I think the technology finds its own uses. So you can develop technology with a use case in mind, but users will potentially find other use cases for it. So clearly, the stablecoin use case has grown beyond being a better wire transfer for Bitcoin traders into becoming a better wire transfer for small businesses and individuals, in fact. And there are some other stablecoins, for example, the DPIX, which is a Brazilian stablecoin that has a lot of store integration. It's issued on Liquid, and There are decentralized sort of trustless market spaces to swap that for Bitcoin or to swap it for Tether, but with local store integrations like in point of sales terminals. So that's quite interesting. I think that the securities, so getting access to shares on other stock markets is difficult globally. It's like complicated for, let's say, somebody in the US to access a small cap stock in the UK or in the Nordics or in France. And so, or in Japan, and the time zone is another factor, right? So, you know, what people were finding, you see people talking about buying treasury companies issued in another country, and they found the only way to buy one of them was to make a phone trade. So like actually call Fidelity, enter an order verbally over the phone, which would take effect the next day, basically. So there's kind of very complicated and uneven access to the market. And so I think the tokenized securities can give a more global, still regulated because you have to get onboarded to be able to buy these. But you know, once you are onboarded, it's a much simpler process. You can trade them 24/7, and you know, it's just a smoother, nicer experience ultimately. And you can also get Bitcoin pricing. And also, you know, the platform can't turn off the buy button, which Robinhood has done a few times infamously, right? So in a blockchain world, it's 24/7 trading, and there's no, you know, market stop, market hold, closed market, bank holidays. And the Bitcoin traders expect 24/7 volatility and trading experience. So it brings the securities into that world, which is a more modern, open for business world with a longer tail and wider access. So I think for people in some countries, it's difficult to get a bank account, never mind a brokerage account. And so if you can, you know, open a Bitcoin wallet, create a Bitcoin balance, get the onboarding to participate, it can be a way to, you know, participate in the global financial markets more evenly as well.
Yeah, I think, I mean, we, from the discussion that we had so far, we already can see that there are mainly three verticals. So you have the pay-fi vertical, so people that want to be able to have access to stablecoin because they don't have access to normal payment rails, normal banking infrastructure. And those are the stablecoin use case that they already exist and they already demonstrate the product market fit. Then you have the traders use case, so people that want to be able to trade Bitcoin against other assets in a decentralized manner without having to give custody to a third party and to do KYC to a third party platform. And then we have the tokenized assets for people that want to be able to move their assets around without being locked into a broker account. So all of these things, they potentially can, they already exist to some degree also on another layer one. So to answer the question, I think we need to answer what kind of user will specifically want it on Bitcoin rather than on other layer one. And I think there are two angles to it. One that people that prefer Bitcoin for the security side and for being interacting natively with Bitcoin, but there's also the privacy aspects. So both RGB, Taproot Asset, and Liquid, they also offer like better privacy than what you have when you transact on Tron or Ethereum or other network. And this is something that people are becoming more and more sensitive about, especially with all the tragic events of kidnapping that happened in the past few months and a few years. So people want to have more privacy. They don't want to that any random people can look at the blockchain and have a pretty good understanding of how much what is their net worth, how much assets they're holding. And because of that, I think those kind of people will be those that are attracted the most to this kind of solution on top of Bitcoin.
Now, another topic, I think it's topical, I'm interested to understand your view, and probably many people in the audience are, what we're seeing, I think excluding Tether, it sounds like a lot of the other stablecoins and other even platforms like Robinhood are doing their own chain, right? Or Coinbase has their own base chain and things like this. So I guess my question for you guys is, how do these solutions like Taproot Assets, RGB, and Liquid, how do they sort of compete or compare with these people who want to do their own chain?
Well, I mean, that's kind of the point. I mean, if everyone does their own chain, there is no interoperability between anything. So everyone needs to bootstrap adoption from zero.
So I guess just let me put this question in. Does that mean then it's going to be a lot about cross-chain swapping and atomic swapping?
No, I think in the world where everyone does his own chain, like you need to rely on cross-chain swapping, and it's not ideal. And also you need to bootstrap security from zero, and it's kind of what we're seeing right now in the multi-chain world, but it's not the best user experience. So I think Bitcoin is the only chain where can truly aggregate, because the only one that is truly neutral, is the only one that is truly not controlled by anyone. And this is also why you have the social scalability to be the Schelling point where everyone goes to do issuance and to do transfers.
Yeah. I mean, I think it's a fair point to say that it looks a little bit like the very early internet, where companies were very suspicious about the Wild West of the internet, and so their inclination was to make an intranet, i.e. like a private network, and disconnect from the internet. And then, as you said, if every company, every bank starts their own chain, it looks a lot like a database, which is what they have today, a closed back office. So, if anything, what the internet taught is that open interoperable networks win because they have faster interoperability, and they develop network value better because you've got cross connectivity. So I think, some people are rediscovering that learning process by having the inclination to want to have proprietary control of the network, not realizing that network value comes from internetworking, connecting with other people, being able to transact assets. So I think in the longer term, there were competing network technologies before TCP/IP, and they all fell away. And there was basically TCP/IP became the global standard. Anything else just kind of folded into it or was used as a routing segment that has TCP/IP on top of it. So I think, in the blockchain space, Bitcoin is that thing. I agree with what you said, that it's basically the only neutral network. Any network started by a bank, started by an exchange that's proprietary and specific to the exchange will never be used by the competitors, because they have the same mindset, which is they also want to control the network. So, they're just going to keep repeating these experiments until they learn the lesson that internetworking is more important, and then they will join the Bitcoin network. I think it's very hard to see them, standardizing on an altcoin, because it would just promote one altcoin, and the altcoins are in a continuous competition and turnover. So I think, and that's also clearly not neutral, right? So I think it's going to standardize on the open network ultimately.
Okay, last 2 minutes. Lalo, you've got the...
Yeah, I think as Adam said, I think they were sort of like rediscover old lessons. People remember the whole like blockchain, not Bitcoin era, from like 2015, 2016. I think they're going through that again, basically, right? I think as we've seen before, like those necessarily didn't work out because, like he's saying, like people want their own little fief thing, they want to control it. Also, the regulatory winds started to shift as well. Maybe they're shifting one direction right now, but in the future, we don't know if that's going to actually hold. And also, you've seen how volatile the U.S. politics are right now, may go one day or another. So I think you still need that decentralized anchor to build on top of itself, and then you can have interoperability within that, right? So maybe they'll put these things out there. We'll see if they actually get traction or not. But still, they're still on this fragile basis, basically, of this whole private blockchain thing that, like, remember R3, all these other things in the past, they're not around anymore, basically. But Bitcoin's still around, so.
I think that's a great spot to finish up. So everyone, please put your hands together for our panelists, Laolu, Adam, and Federico.